Hi everyone, I'm Bonn and today I'm going to present about the topic, the value of things and the value of money in investment. So firstly, we need to define two things, the value of things and the value of money in investment. The value of things is a theory saying that each additional unit of a particular object decreases its value. For example, I need a pen so that I can write words of presentation here. But this pen has already a lot of ink, so I can write whatever I want in here. If so, when mom gives me another pen, I wouldn't need it as much as I needed the first one because now I have two pens, it's more ink, but I didn't necessarily need this pen because I already had a full ink pen. That is the value of things. Next, we need to understand what the value of money in investment is. Generally speaking, when each additional unit of money is added, the value of the total amount increases because of addition. However, these can be tampered with. Why? Because the value of money isn't only considered by the investments or the addition of the units of money, but it is also determined by the time value of money, the investment factors, and so on. So in short, we have two main factors that make up the value of money in investment. The investment factors and the time value of money factors. Well, I would like to explain the time value of money factors first because it is more simple to understand. For the time value of money factors, we are taking the inflation, the investment opportunity, and the consumption. The inflation is the rate that the investment goes up or down to where increase or decreases its value. Consumption, how the money is used. If we put our money in an investment that doesn't use our money in a good way, they will probably fail. There is a bigger chance that they will fail than succeed. And lastly, investment opportunity. What I mean here is not an opportunity to invest in that branch alone, but you see, in a company, it's not only just the main part, it has smaller branches everywhere. So the value of opportunity cost in investment opportunity is applied into this board. A company cannot stay independent. It has all of these little branches in order for it to function efficiently. For example, if I really wanted to invest in, let's see, Roblox, that's a really cool studio, and it has every branch that a company needs, like the development of that app or studio, a marketing branch, and an executive brand. This means that a company has more branches that we can also invest in. And a common saying that says, don't put all your eggs in one basket, because what if we only invest in the main company, the brand, and then it failed? We could spread or minimize this risk by spreading in all the branches. So even if one part of the company failed and the other succeeded, we would have not lost any money, or even possible, earned a little bit of money. So TVM factors are those three most important things: inflation, consumption, and investment opportunity. Next is investment factors. In investment, you put your money into that company and it will spend it effectively and give you the amount of interest or repay money that you both have agreed. So to make this example, we first need to understand what investment consists of. For an investment to succeed, we first need to understand the risk associated with the investment. Next is probably the most important part, the profit part or the return rate. It means that how much percentage you would get from investing in that branch. And lastly, it also has three factors like the time value of money. This is the most important part. That is, what currency are you investing in? And in which company is the fourth factor. These four factors, risk, other companies, currency, and the return rate, are one of the most important factors in investment. The risk, there is a complete difference between uncertainty and risk. Risk is that it's risk and there's danger ahead of you, but there's also a potential one all the way to the end. While uncertainty, you don't know anything at all and you're confused, left in the dark without a light. That is risk. Next, we have the return rate. Different return rates vary from investment branch to another, as well like gold. If the value of gold increases, you get profit. If it does not, you lose profit. And it has a genuine return rate of 8% according to my research. So continuing on the subject, while gold has an 8% of return rate, the stock market has around the percentage of 13%, which is a considerable amount higher than the gold, which means that if an investor chose in the stock market, he would have about 7% less to fail. So the third factor of the investment is the currency we are investing in. Different currency values vary. For example, one Vietnamese dong is about the same as 25 or 26 of the US dollar, which means that $1 is equivalent to 25 or 26 Vietnam dong, which is about 25 to 26 times more the economy of Vietnam. Next is the company we are investing in. Bad companies tend to fail our investments, while good companies like Apple, Spotify, maybe large social media platforms would increase our chance of succeeding our investment. So now, after we have understood the investment factors and the time value of money factors, we need to understand how the value of money works in investment and its value of the money in the investment. So we need to combine both the investment factors and the time value of money factors in order to consider the value of money in investment. For example, my value is $100. I have $100 put into investment at Roblox in every branch. This branch has $10, $50, $30, and $10. Then we would have to consider the amount of money you're putting in, which is the currency, and the dollar is almost the highest pricing of investment. So we will not need to worry much about the investment value. So we have the value of the money substandard. Next, I need to agree to a plan with the company I'm investing in. They need to give out a acceptable return rate. For example, I put in 100% and they promised to give me back 130%, which means that by the end of my investment, I shall have my $100 back and a profit of $30 crisp dollars. Then we would have the consumption part. If our money isn't used correctly, they would likely to fail, which means that we have less profit, obviously. And lastly, the investment opportunity. I have spread it out all of my investments. Even though not all of them would succeed, thankfully, some would succeed, and I would not risk losing all my money because this is extremely rare, coupled with the high chance of losing the money. And now I need to understand the investment factors in the company I'm investing in. So firstly, the risk. If I'm investing in Roblox that makes gold, I'm going to expect a failure. But if it works really hard in the stock market, I might be more destined for hope. I might invest in their company more often because I know that the exchange rate and return rate of the stock market is high. Lastly, I would need to consider Roblox, the company I am investing in. If Roblox is going down in the stocks, my investment will likely to be a failure. If vice versa, it will go up. So, conclusion, the value of things is a shrewd understanding for us, which boosts our morale and makes us understand a little bit of the value of money in investment. The investment factors, time value of money factors, affect directly to the value of money in investment. And for change, that is the conclusion of the topic, the value of things and the value of money in investment. Thank you for listening. Bye-bye.